Hi everyone, welcome to Trade Zone, the final episode for May, powered by Track Record Trading Academy and sponsored by Eightcap. Let's talk about markets. So today we are going to go through an update on the Kiwi dollar trade, the sell Kiwi dollar trade that happened because of the Reserve Bank of New Zealand's dovish pivot, right? So and we'll give an update, just a short summary on the debt ceiling issue. And then finally, we'll talk about what's on the data calendar this week. And we'll round up the session with a trading tip on how you can continue to improve and become better in your trading journey. So let's do a recap of what the Reserve Bank of New Zealand said last week. Basically, they raised interest rates by 0.25% as widely expected to 5.5%, but they shocked the markets when they forecasted that policy interest rates will stay at 5.5% till June next year. So basically, they're saying this is the last rate hike of the cycle, and their next move is to cut. And that is a very shocking surprise to the market because the month before, in the previous policy meeting, they shocked the markets by hiking 50 basis points, 0.5% instead of 0.25%. So they've gone shocked one way, too hawkish, and then now it's too dovish. And they are projecting interest rate cuts from the third quarter of next year. So this caused New Zealand dollar to fall off aggressively, more than 1% in an instantaneous reaction to that piece of news. It broke through supports, which became resistance, as you can see the yellow lines. And at that point, we said that the support is at 61.10, and since then it has broken through quite convincingly. And you can see that once it broke through, it also retested, and then finally it just never threatened that level again. You can see that once it broke through, the support becomes resistance. So that's something that you should always keep in mind of when resistance is broken to the downside. Support is broken to the downside, it becomes resistance on the upside, and vice versa for supports and resistances as well. So what we have now is that as of telecast time, it's at 60 cents, and that is very close to psychological support and also the previous low from September last year. So we see temporary support at 59.90. However, that is looking pretty shaky given that overall the New Zealand dollar and also the Aussie dollar is trading very weak since earlier today. We had Chinese data which showed that the economy is not as strong as expected. So the expansion in the Chinese economy is faltering, and it being one of the biggest trade partner for Australia and New Zealand, and it's bad for both their currencies. So if it's going to break through, if it does break through, we will see support next at 58.40. And you can see I use congestion area as well as previous lows as points as reference to figure out where I think the support is. So there's a very simple and consistent way to get some reference levels. So that's how I do it. I keep it simple so that it is not too arbitrary and not dependent on my mood at the period of time when I'm looking at the charts. So in any case, it's likely to go further lower, and if you look at the lines here, once we break convincingly through, those lines will become resistance, and it can be the levels where you want to sell against if you are following these charts that I'm referencing. So anyway, the debt ceiling discussions over the weekend. Earlier this week, we saw President Biden and Republican leader McCarthy agreeing to a deal that will end the US debt limit crisis for 2 years. Basically, they're just kicking the can down the road again, and that's pretty much what they've been doing for years and years, and they will continue to do so. And the deal is expected to be passed by the Congress later today in US time zone, and then it will have to go before the president to be signed into law. There is a small chance of failure, maybe some rebels who decide to vote against it, but it's unlikely to stop the bill from going through, and it's unlikely to put the US at risk of default in any time soon. So that's good for market sentiment. And what's important this week, we have still the debt ceiling approval process, of course, but it's likely to be going through quite smoothly now. And today we will have US jobs opening data, JOLTS opening data, job vacancies later in the US time, and when the markets open, and it will be likely to show that the number of jobs vacancies has declined to 9.35 million. Still high, but it's good if it's starting to be softening and going lower. That's what the US Federal Reserve wants with their interest rate hikes. They want the jobs market to be more moderate, be less inflationary because of wage pressures when there's too many jobs and not enough people to employ. So, but on Thursday, we will see Eurozone inflation data. It's expected to show that prices rose 6.3% year on year, and it's a drop from the April's 7%. But it is unlikely to have a big market reaction unless it deviates much from the what is expected. The core index, which excludes energy and food prices, is expected to be showing price rises of 5.5%, a slight moderation from the April's 5.6%. And unemployment rate is expected to remain at 6.5%, but inflation still is the most important data point for the European Central Bank. So if we should see it higher than expected, it will increase the risk that the ECB will have to be talking aggressively about inflation again. And if it should be softer than expected, I think it will reinforce the narrative that inflation will start to go down aggressively towards the second half of this year, as predicted by some of the major central banks. And also, we will have the US ADP employment change data. It is likely to show that jobs increased by 170,000 in May. It's a big drop from a lesser increase than the April's 296,000, but it is unlikely to have a major impact on the market because on Friday we will have the more important job metric, which is the US non-farm payrolls. It's expected to show that jobs added were 195,000, also a drop from April, a moderation from the April's increase of almost 250,000 jobs. So unemployment rate is expected to show a rise to 3.5%, a tick higher from previous print of 3.4%. If we should see a moderation in the jobs market, it will increase the chance that the US Federal Reserve will hold interest rates in its mid-June meeting later next month. So now we move on to a trading tip that will help you improve your investment process. We know that there's going to be event risk in our journey of trading. So it's always going to be, we have to be prepared for market reactions to different events and different data points. And of course, events can be either expected or unexpected. Expected meaning their plan is ahead of time. You know the data calendar. You should know the data calendar and should try to figure out what's important. And if you don't, please feel free to tune in to our Trade Zone or follow us on social media, and we do update on a timely basis on what's driving the markets and what's important at any point in time. So unexpected events, you cannot really predict them sometimes, but you still need to be prepared, and we'll go into that in the next few slides. So expected risk event. So expectations, these events are planned in trading calendars ahead of time. Every month there's a fixed dates that data points that are important will be released. For example, inflation data points, jobs data points, as is the case for this week, is job data points in the US. And it is important to know what market expectations are, to know what the market believes will be the likely outcomes, and then be prepared for it, because market reactions are not markets do not react to absolute numbers. They react to numbers relative to what is priced and what most investors already expect. So if everybody is expecting a strong number, a moderate number will be considered a weaker number. And I'm sure, as you have seen in the past month, we have highlighted several data points that are important, and then we have also highlighted the reaction to that. And if you put in more time to figure this out and to understand this, it will help you in your trading journey and also help you in your trading process. An example of important data points and events that are planned will be central bank meetings, especially the major central banks like the US Federal Reserve, the European Central Bank. And importance of data points truly depends on what the markets are concentrating on at any point in time. So for now, the narrative that the markets is trading off is that inflation is still too high, jobs market could be too strong, and the, 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 the Fed, the US Federal Reserve, is now highly data dependent. So they will be more watching these two set of data to figure out what their next steps would be, right? So this importance changes as time passes, as well as through different economic cycles and also different macroeconomic environments. And that's why it makes trading not so easy, right? Because it's not always consistently the same few things that drive markets. So to mitigate such risk of events that are on the data calendar, we could by knowing what expectations are and what are the risks to the positions that we have, we can mitigate risk by reducing the size of our positions, especially if it's expected to be extremely volatile given the unknown, the uncertainty of the situation, and the also if your stops are very close to current market levels, then maybe it makes sense to insulate yourself from randomness. You either reduce your position, take off the position, or widen the stops. But definitely, if you widen the stops, you have to reduce the size of the positions, because at any point in time, you should only be willing to lose a limited amount of your capital on any one trade. Okay, so important, I believe it is important to have views and trades. They are not reliant on any one outcome of any data point or any event, right? You'll be surprised at how many retail traders as well as professional traders, they like to take bets on outcomes where truly they do not have any edge in figuring out. They're just guessing, right? But to me, that is basically gambling, basically taking a punt, and truly that is not the habit of a successful trader in the long run. Because if you're gambling and taking punts, eventually you will be taken out by randomness. And if you do tend to bet on events where you have no edge, you have no extra research beyond what you read on the internet, you truly do not have an advantage, and you do not have an asymmetry of risk reward profiles, right? And so what we can, even if, and it's important to remember this, even if the hoped for outcome sometimes occurs, market reaction could be very different to what you expect because of different dynamics. So it is important to not be reliant on any one outcome for your trades to work. So unexpected event risk. So some of these events are, we call them wing risk, or even known as black swan events, which are truly unexpected. For example, the COVID crisis, the COVID pandemic, the war in Ukraine, although it was well telegraphed by the US and Russia over periods of time, but it was still quite unexpected. And sometimes, unfortunately, terrorist events that are unexpected as well could affect markets. And some of these could be predicted beforehand if you have a robust scenario analysis, as well as you're very well aware of what geopolitical risks are, and also other telltale signs that could be predictive of what is to come. But quite often, it is really unpredictable. Basically, these are events that no one expects but may happen. So how do you plan for such events? Well, it is basically, you have to always be thinking that something that is unexpected could always appear or could always happen. And as such, you need to run through scenario analysis for the positions that you have, especially if you have too many positions. You need to know how they're going to react in event of a market disruption. So again, the only mitigation strategy is risk management, is to not have your to constantly ask, what if this happens, what will happen to the trades that you have, the portfolio that you have. Is especially important if you start to have different trades in different asset classes. You need to constantly know what are the correlation, how different trades will tend to move in different extreme scenarios. And this is a good mental exercise, because once such events occur, volatility usually spikes. Swings will be wild, market liquidity will be much reduced, meaning trading volumes will become very gappy. Sometimes it's not, you cannot even really trade at a good price. For example, post September 11, the spreads in the FX markets widened to levels not seen since the early 90s, I believe. So volatility usually spikes, and the cost of trading will rise. There will be more wider bid and offer spreads. So you need to be aware of this. Sometimes even you want to, the level that you want to get out at may not be available for you to exit, right? Because the market could gap. There could be illiquid periods of time where it just gaps, and then you are 1-2% away from where you want to stop out. So you need to be aware of that. Need to always factor that into your risk management, and never allow your portfolio to be so vulnerable to the unexpected outcomes that it can lead to financial ruin. For example, a clearest case in point was the case of some people putting all their cryptos in one crypto exchange, and when the crypto exchange failed, all their money was basically gone, right? So they lost access to their money, even though they did not lose any money on trading. They lost it on having concentrated risk in any one platform. So it's important to have platforms that are regulated and be audited as well. So it is in trading, it is all about surviving. So it's focusing on risk management first and foremost, and then be prepared, and always be prepared for heightened volatility. And it is never wrong to reduce risk if you're uncertain, because this trading journey is going to be a long one. If you want to survive, you will have to learn how to cope with all these uncertainties. And most of the time, best policy is to reduce risk if you are unsure of what to do. Otherwise, it becomes, as we said, merely betting on randomness and hoping for the best. And always remember that when things go wrong, the cost of trading likely will go higher as well. Bid offer spreads will widen, volatility will spike, swings will be high, markets will be wild. So it is always important to have that at the back of your mind, and remind yourself that this is a journey for the long haul. It's not about trying to make it all in one go, because if you do, most likely you will lose it all in one go. And as Paul Tudor Jones said, one of the most successful hedge fund managers of our time, don't focus on making money, focus on protecting what you have, and eventually that will lead you to trading success. As always, stay true to the trading process, and eventually you will become much better, and you will develop habits that will lead you to the success that you seek. This is our last telecast for May. Thank you for staying with us. Thank you for being with us, and good luck.